Welcome back to Investing Talk podcast. Okay, today we're diving into one of the most, well, let's just say explosive and frankly fascinating stories on the market right now. Our focus is squarely on the company IREN, and we're here to tackle that critical question, the one many of you are probably asking, is IREN actually a good time to buy now? The hook here is, well, it's impossible to ignore, isn't it? This stock has seen something like a 1,000% increase from its lows back in April. That kind of incredible climb, it's fundamentally driven by one big thing, the explosive, almost, insatiable demand for AI infrastructure. And Iron's ability to pivot its whole business model to meet that need. I mean, that level of performance, it doesn't just happen, right? It reflects a massive strategic shift, and that's why the current state of this stock is just so compelling and, yeah, maybe a bit controversial too. Before we really get into the nuts and bolts of the financials, please take a quick moment to subscribe, like this analysis, and comment below. Seriously, if you want us to put a specific company under the microscope for a future analysis, just leave a comment with the name. We really do build these just for you. All right, let's start by unpacking this recent roller coaster ride. I mean, when a stock goes up 1,000% in 6 months, you kind of expect volatility, right? But IRN has certainly delivered on that front. Back in October, right after that massive run-up, the company announced a pretty significant financial maneuver, a convertible debt offering of $875 million, which could potentially increase up to, what, $1 billion?
Yeah, $1 billion. That's a big chunk of change, especially for a company of its size at that time.
Exactly. For a company this size, that's a big capital raise.
It absolutely is. And what's really fascinating is how the market reacted both, before and immediately after. That debt offering, like you said, it did trigger a brief dip, about 6%. But if you zoom out just a little, the positive market sentiment leading up to that was just, well, overwhelming. It suggests investors were already pretty comfortable with this idea of high growth needing high capital.
Yeah.
Just look at September. We saw analysts aggressively raising price targets all over the place. The sources we looked at highlighted firms like Canaccord Genuity Group and Cantor Fitzgerald showing, intensely positive sentiment. Sanford C. Bernstein, for instance, they didn't just keep an outperform rating, they reiterated it with this really ambitious target price of $75. The confidence was just palpable,
Yeah.
and it essentially shielded the company from any real sustained damage from that debt announcement.
Okay, so if the market basically shrugged off a potential billion-dollar debt raise, the underlying reason, the fundamentals must be incredibly strong then. What exactly was providing that foundation for all that analyst bullishness?
It really all connects back to their August earnings report.
Yeah.
They reported $0.19 EPS, earnings per share, which comfortably beat the street's expectations by $0.02. Now, that might sound small, 2 cents.
Doesn't sound like much, yeah.
But it was massive for validating the whole strategy. The sources are really emphatic about this. This confirmed a strong, successful pivot towards AI cloud services. This wasn't just some side project anymore. It was proof positive that the massive infrastructure build-out was working, fundamentally shifting the company's identity beyond just being, a digital asset miner.
Okay, that makes sense. High growth needs fuel, needs capital, and investors will stomach that if the underlying strategy looks sound, looks like it's paying off. But still, if we're talking about potentially $1 billion in capital being raised, what kind of scale and profitability are we actually looking at here that justifies this kind of valuation? Let's get down to brass tacks.
Right. The strength really seems rooted in two main pillars. Just the sheer scale they've achieved and some pretty impressive financial discipline. So right now, IREN commands a significant market cap, around $16.81 billion. And when we look at their recent performance, their trailing 12-month revenue, that's TTM revenue, was $501.02 million. And out of that, they generated a net income of $86.94 million.
Okay, $87 million net income on $500 million revenue.
Exactly. Now, here's the number you really need to kind of stick in your memory. That translates to a really robust net margin of approximately 17.3%.
Wow, 17.3%.
Yeah. For anyone familiar with, say, the energy sector or even the data center world, getting a net margin that high, it demonstrates incredibly disciplined cost controls running alongside that very aggressive top-line growth. They aren't just growing fast, they're apparently growing efficiently, too.
That 17.3% margin is genuinely eye-opening, yeah. And it leads us right into what the sources suggest is IREN's key long-term differentiator, their competitive edge, or their moat, as they call it. They operate on this vertically integrated model. Now, for listeners maybe less familiar with that concept, why is owning the hardware and the data centers and the power infrastructure, Why is that such a massive advantage?
Well, it basically creates this huge barrier to entry for competitors. And it really explains that high profitability we just talked about.
Hmm.
Think about their competitors for a second. Maybe they only own the data center or perhaps just the mining hardware itself. Now, if energy prices spike, let's say because of geopolitical events or even just seasonal demand shift,
That happens all the time.
exactly, those competitors, they have to buy power on the volatile spot market. Their margins, poof, they just evaporate almost immediately.
Oh, okay.
IREN avoids most of that volatility because they own their infrastructure and, this is critical, they've secured these long-term, low-cost renewable energy contracts, particularly at the big sites in Australia and Canada. They can basically stabilize their single largest operational cost for years out. This makes their whole business model incredibly resilient against the very thing that often sinks their peers.
Yeah.
That volatility in energy prices. They could potentially maintain that 17.3% net margin, while others are, frankly, struggling just to stay positive.
That is a fundamental strength. It essentially gives them predictable costs in what's usually an inherently unpredictable industry. Makes sense. Okay, this leads us back to the valuation question. If the fundamentals are strong, how are analysts actually treating this high growth, high volatility profile? And importantly, what's the risk attached?
Well, the consensus outlook, it definitely remains extremely bullish, but they absolutely acknowledge the high valuation. It's hard not to.
Yeah.
The current PE ratio, the price to earnings, sits somewhere around 157.26.
Whoa, 157.
Yeah, that is priced for, well, absolute perfection, you could say. However, the analysts seem to believe that the massive future revenue acceleration they're forecasting will quickly compress that forward PE ratio down to something like 62.32.
62 is still a huge multiple, though, isn't it? I mean, isn't that still pricing in, if not perfection, then nearly flawless execution over the next couple of years? What kind of historical context do we even have for growth stocks managing to maintain a 62 PE successfully?
Well, it definitely requires continued growth that doesn't just meet, but exceeds expectations quarter after quarter after quarter.
Mm.
No room for error, really. And that brings us directly to the risk metric you absolutely have to understand with this stock. Their beta is currently 4.20.
Hold on, rewind. 4.20 beta. Okay, for listeners maybe less familiar with that specific metric, can you quickly frame what a beta of that magnitude actually means for the average investor just watching the daily price action?
Absolutely. So think of the market benchmark, like the S&P 500. That has a beta of 1.0 by definition. A 4.2 mil beta means that if the overall market moves up 1%, IREN stock, at least in theory, tends to move up about 4.2%. Big amplification.
Okay, sounds great when the market's up.
Right. But, and this is the crucial part, if the market moves down 1%, IREN theoretically moves down 4.2%. It reflects extremely high sensitivity and just extreme exposure to sector volatility, especially tech and digital assets. It's definitely a high-stakes, high-reward kind of stock. Demands constant attention, really. And their internal strategy seems to confirm this risk appetite, right? They're favoring aggressive reinvestment in building out more infrastructure over paying shareholder dividends.
That's really critical context. So, okay, we've got strong margins built on this vertical moat, the structural advantage, but the price action itself is magnified by over 4 times the market's general sensitivity.
Wild. Now, let's shift gears a bit. What are the charts telling us about investor confidence right now? Given all this volatility, what does the technical picture reveal?
Yeah, looking at the charts, it's pretty much a textbook uptrend despite the bumps. As of, say, October 24th, the stock's trading somewhere near that $52 to $58 range, which is, of course, just a galaxy away from its 52-week low of around $5.13.
Night and day.
Totally. And technically, the price remains firmly above both its 50-day and its 200-day moving averages, key indicators. This confirms that the rally isn't just, a flash in the pan. It seems well-established, aggressive, but established.
Okay, let's talk about those crucial technical levels then. Where is the stock finding reliable footing, support? And what are the major hurdles ahead if this momentum keeps up? Good question. Key technical support seems to have been firmly established right around that $50 mark. That's become a critical psychological level, it seems, and a strong recent base where buyers have stepped in. Accumulation zone. Major resistance sits pretty close by, right around $60. That seems to be the next big test. Now, if the stock can decisively break through and hold above $60, the next significant challenge becomes that 52-week high up at $74.15. That's where the real upward pressure will likely be tested again.
$74. Quite a ways still.
Yep. And regarding momentum, there are still positive signs according to the sources. Momentum indicators, things like the MACD, they remain bullish. And importantly, the sources noted there aren't any recent overbought RSI warnings, which suggests there might still be technical room for more gains before the stock gets truly overheated and, requires a major correction or consolidation.
So room to run, technically speaking.
Potentially, yes. And market confidence seems reflected in the analyst community, too. The consensus rating is a strong buy.
Huh.
There are 8 analysts covering the stock, apparently, with a mean price target of $59.25 right near that resistance level we mentioned. And one high-end target is reaching for a pretty ambitious $100.
$100. Okay, so if the charts are generally bullish and the fundamentals seem strong despite the valuation, what specific confirmed events could actually trigger the next major price movement over, say, the next 3 months? What should we be watching for on the calendar?
Right, the catalyst. The
Mhm.
primary near-term one is already confirmed and should definitely be circled on your calendar if you're watching this stock. It's the Q1 fiscal year 26 earnings release, scheduled for November 6th. That's the consensus #1 trigger. The market will be laser-focused on seeing if they can maintain that impressive margin and, crucially, how much that AI cloud revenue is really accelerating. That's the key story.
Got it. November 6th. And beyond November, anything else scheduled?
Well, looking further out, towards the end of the year and the start of next, the sources point to potential ETF rebalancing in December, which often requires large funds to purchase significant blocks of successful high-beta stocks like this one. Could drive demand.
Interesting institutional angle.
Yeah, and furthermore, there are expected institutional buys, typically clustered around January 10th. That period often sees new allocations. Increased institutional investment is really seen as essential for providing some long-term stability to that high valuation we keep talking about.
Okay, that covers the confirmed stuff. Now let's talk about the more speculative elements, the rumors, the whispers that could inject even more energy into the stock beyond just the earnings reports. What's out there?
Yes, the whispers are pretty substantial, according to the source material. There are rumors circulating that IREN might be looking to partner with major established tech companies for its AI cloud services. If they landed a big name, that could potentially boost revenue significantly beyond even the current bullish consensus expectations. A major partnership announcement like that would be a massive windfall for the stock.
A game changer, potentially.
Could be. We also see speculation about potential strategic acquisitions, maybe designed to enhance both their AI compute capacity and possibly their existing Bitcoin mining capabilities. Bolt-on growth.
Okay, that all sounds incredibly promising, almost too good to be true in some ways. But we must circle back to that 4.20 beta. What are the major risk factors an investor needs to be acutely aware of, even with that robust vertical moat protecting them?
Right, reality check time. The primary risk really comes from the fact that despite this successful AI pivot, they are still fundamentally tied to some high sector risks. They remain highly exposed to Bitcoin price volatility. Let's not forget that. A major downturn in digital assets will almost certainly affect their valuation, regardless of AI revenue.
Still a factor.
Definitely. Furthermore, while those long-term energy contracts provide stability, significant power cost spikes are always a potential threat. Maybe less likely, but possible. And of course, shifts in regulatory regimes impacting the digital asset side of the business are an ongoing concern for the whole sector.
Okay, sector risks. What about competition?
That's the other big one. The critical competitive threat is the one that really challenges their moat directly. Other Bitcoin mining companies are now actively trying to replicate IREN's successful AI pivot strategy.
Ah, the copycats arrive.
Exactly. They're seeing IREN's success, the margins, the valuation, and they're trying to acquire the necessary infrastructure themselves. Now, if this competition floods the market with similar AI compute capacity, it could definitely challenge IREN's ability to maintain that impressive 17.3% margin advantage going forward. That's a key battleground to watch.
Okay, that makes sense. Competition could erode the edge. So let's try and bring it all together now. Let's synthesize the overall investment thesis that emerges from these combined sources. What's the final word on IREN?
Well, the verdict seems overwhelmingly positive, doesn't it? The sources give it an overall bullish rating of 9 out of 10. The stock is described as compelling for potentially short-term trades, maybe targeting that November earnings catalyst window we talked about. But it's also framed as highly attractive for longer-term investment, mainly due to that resilient, vertically integrated model and its critical infrastructure advantage in a sector that's clearly in super high demand. Agreed, it hits both notes. And maybe here's a final provocative thought for you, the listener, to consider. Something to mull over as you weigh the risk and reward here. Given IREN's heavy reliance on those low-cost renewable power contracts and its whole vertically integrated setup, Perhaps the most important long-term question isn't just about the price of Bitcoin or even the immediate quarter-to-quarter success of the AI pivot. Maybe the truly defining challenge, looking out years, will be how resilient the company proves to be if or when global regulatory bodies start seriously taxing or restricting high-energy data infrastructure. Think about potential carbon tariffs or other climate-focused regulations. Will their current diversification and renewable focus truly protect that significant margin advantage in that kind of future environment? That future regulatory landscape. That could be the ultimate test of their moat. Something to think about.